Wall Street have issued their price target for the S&P at the end of 2025 to come in between 6,400 to 7,100, and if we look at it right now, that's around a 10 to 20% gain. But do bear in mind, when looking at analysts and their predictions, just in 2024 they came in significantly under, and with the poor start to 2025 that we have seen, it is anyone's guess where we are going to be at the end of the year. But today's episode, we are focusing on 3 high growth stocks that we are buying. We see a lot of opportunity, and in fact better than what we believe the S&P will return this year. Now the first one is Grab. For those that don't know, they are a Southeast Asian technology company, and they provide a variety of services like ride-hailing, food delivery, digital payments and financial services, and they operate through the app, allowing users to book rides, order food, pay bills and access other on-demand services, and they are widely used in countries like Singapore, Indonesia, Malaysia, Thailand and the Philippines. And if we jump straight into the company, first thing we want to point out, it is a double strong buy rating, quite rare on the channel, from both Wall Street as well as Quant, and Seeking Alpha also give this a buy. Right now it is trading in the midpoint of the 52-week range. We do want to point out it is on the lower end of the market cap. We do typically analyze on this channel around 18 billion. Over the last year it is up around 35%, and when we do take a look at their earnings, the next quarter they are anticipating 96% growth on a year-on-year comparison with the earnings per share, and over the last 4 quarters they had one miss, and that in turn gives this a 75% track record, and the beat that we see in the most recent quarter was fairly marginal, so you can have some degree of faith that they will hit their target, which for this year they do see around 5 cents, which in turn gives the forward P right now around 94, which is very high, significantly higher than the S&P, but bear in mind this is a high growth quality company and one that we do believe over time will come down significantly. And just looking at their latest earnings, we can in fact see revenue is up double digit on a year-on-year comparative. We also notice their demand is also up around 15%, and it does look positive in terms of where they are moving. We are going to show you the underlying metrics moving in the right direction. Now, no surprises on the valuation, they do get a C+, although it will come down to which valuation metric used. For example, if you look at a price to book, whether that's on a trailing 12-month or forward looking, they are trading at a marginal discount. If you look at the price to sales or the EV to sales, then this is considered to be trading at a premium, something that also holds true if you look at it on a price to cash flow basis. But do remember, it will come down to individually where you use the valuation process, and we're also going to run it through the DCF model shortly to give you our overall view. Now, in terms of the growth, they get an A+. This is what we like to see. 22% revenue over the last 12 months, better than the sector at 4. Forward looking, 33, better than the sector at 5.2. And we can also see both their free cash flow growth, 571% on a year-on-year versus 7 from the sector. Operating cash flow 551 versus 6.84, so definitely ticking all the boxes for when we do want to analyze growth companies. And profitability, they get an overall A. Gross margin 42%, sector comparative at 32. However, one thing that we're not particularly keen on is their bottom line net margin, around -4%, with the sector at 6.5. Definitely something we would like this to turn positive very soon. If you want to look at the free cash flow margin, very high, 43%, sector around 6.8, and their cash from operations coming in 573 million versus the sector comparison at 344. Now we will show you some other metrics, but just a quick snapshot. Double strong buy, as we said, Wall Street and Quant. Buy from Seeking Alpha, C+ on valuation, A+ on growth with an A on profitability. Now, in terms of the underlying metrics, free cash flow per share, we always say consistent growth over the longer term, and actually this is what we are seeing. They did have a negative free cash flow in 2019, but it has gotten smaller and has turned into a positive based on the trailing 12-month growth anticipated over the next 12 months. And do bear in mind, this is typically where the large amounts of money are made, and when companies go from negative to positive. We've seen this with many companies, including Palantir. And then we see the sales growth looking fairly strong over the last few years, 22% on a trailing 12 month. As we just showed you, over the next 12 months, they are expecting growth in the 30s, and their total sales numerically going from around 470 million in 2020, 2.7 billion on a trailing 12 month. but we do need to make you aware in terms of shares outstanding, they have diluted your position over the last few years. One thing we always say, definitely keep an eye on, this isn't a big issue as long as they can outperform the S&P. In terms of ROIC, one of our favorite metrics, now ideally we want to see 10% or more. Give us faith, management are able to effectively allocate their capital, and whilst we don't like this, it is getting smaller and smaller in terms of the negative, currently sitting at negative 3% on a trailing 12 month, and the same does apply from the operating margin from 2020 right now sitting at negative 8, and the free cash flow we can see on a trailing 12 month, it is actually positive at 18%. And one of our favorite things about this company is the net debt to EBITDA, currently sitting at 0 on a trailing 12 month, 0 anticipated over the next 12 months. And what this tells us, it won't even take them one day to pay off all of their debt net of cash on hand. So a very strong balance sheet. Definitely something we want to see with the issues that we have flagged earlier on in terms of the negative margin, although that is getting smaller and we do anticipate it to be positive over the next year. In terms of the institutions, well, they currently hold around 55%, and whilst we do see around 540 million worth of sales over the last year, in the same time frame we see around double the amount of buys. So institutions clearly fairly bullish on this company, and if we look at every single quarter in 2024, Q1, Q2, Q3 as well as Q4, institutions have been buying more. As we always say, do your own due diligence regardless of what the institutions do. Now we're going to jump into the valuation, where for Grab we get around $6.18, and this is derived through the DCF model. So we have the free cash flow year on year. Average growth rate, it is negative as it does skew from negative to positive, but moving forwards we've gone for around 30%, which is lower than analyst targets. With a discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, just over $6, which indicates around 38% upside over the next year. Definitely higher than the 10 to 20% from what the analysts are expecting for the S&P. And don't forget, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Grab or any others. But full transparency, we will show you, even at the 25% at $4.97, it does show upside, although fairly minimal at 11. And for those that are a lot more optimistic, at 35%, $7.75, around 73%. Now we will take the medium rate as we typically do on this channel, and then apply a margin of safety, which as we always start off with, 10%. Execute on this only if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. So buy up to 556, and as we keep going in today's episode, we can in fact see that this is a 25% MOS up to around 463, with Wall Street themselves indicating around 27% upside over the next year at a $5.70 price target. Now, a few things to consider with Grab. In terms of pros, they are a strong market position right now. They're a leader in Southeast Asia's tech ecosystem, offering a wide range of services across ride-hailing, food delivery, and financial services. They also have diversified their offerings, which does help in terms of reducing reliance on any one service, providing multiple revenue streams. They also have a large addressable market. Southeast Asia's growing population and increasing smartphone adoption do present a large and expanding market for their services, and they are still right now in their growth stage. Opportunities to expand their user base, geographic reach, and their service offerings. But we also need to think about some of the cons. There is intense competition from other tech companies like Uber and local ride-hailing or delivery services, which could ultimately impact their market share, in fact limiting it. Possibly regulatory challenges, as they do operate in several countries with varying regulatory environments, which could lead to legal and operational hurdles. And they've also currently struggling to achieve consistent profitability, as they do have some high operational costs, especially in their ride-hailing and food delivery segments. And finally, the company is susceptible to economic downturns, as demands for services like the ride-hailing, food delivery may ultimately decrease in challenging economic times. So overall, whilst this company does have growth potential, they do also face risks like competition, regulation, and path to profitability. Now, before we move to the next growth stock, just to let you know, we have released our latest free weekly article, which we deliver one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 46 undervalued stocks for the month of January, as well as the upside that Wall Street themselves believe for each one. And on top of that, you can grab a recently released copy of 43 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and read straight away. We then move on to the next growth stock, which is MercadoLibre, the largest e-commerce platform in Latin America. Now they operate very similarly to Amazon, offering online shopping, digital payments, financial services, and some of their key services are the online marketplace, allowing individuals and businesses to buy and sell a wide variety of products, including electronics, clothing, household goods. They also have a digital payments platform, Mercado Pago, where in fact enabling users to make online payments, processing transactions using digital wallets, and they also have a logistics service that facilitates shipping and delivery across the region, as well as a financial service offering loans and credits to consumers and businesses. They are also a major player in Latin America's digital economy and continue to expand their service. Now they're up only around 10% over the last year, but over the last 10 years they have massively outperformed the S&P, up 1,374%, trading right now in the mid to lower end of the 52-week range. A strong buy from Seeking Alpha, a buy from Wall Street with a hold from Quant. And if we do take a look at this company and their earnings expectations, well, out of the next 4 quarters, only 2 of them they are anticipating growth, and whilst they did miss their most recent fairly substantially, they still have a 75% track record. If they do hit their target, December 2025, that does mean their forward P right now sits around 39.1. Then we can take a look at their valuation. Probably no surprises, majority of growth stocks do currently trade at a premium. They get a D-. When we do take a look, even though this should be lower, the conclusion still remains. Right now, this company does trade at a fairly high premium, something that we pretty much see on 99% of whichever valuation metric you do want to use. Having said that, they do get a growth grade where it is an A, revenue year on year 35%, forward looking 34%, better than the sector median on both accounts at 2.2 and 3, and we also notice the earnings per share over the longer term anticipated to grow at 31% with the comparative at 10.6, and we can also see on other metrics looking fairly good with the A and the A+. Speaking of A+, they get that for profitability with the margin at 52%, sector at 38%, bottom line at 8% again versus 4.4, and one thing we always draw your attention to, which looks very good here, 7 billion of cash from operations over the last year, sector median around 274 million. So again, quick snapshot, strong buy from Seeking Alpha, buy from Wall Street, hold from Quant, D- on valuation, A on growth with an A+ on profitability. In terms of their underlying metrics, looking very good in terms of the free cash flow, massive growth over the last 10 years, expected to increase rapidly again over the next 12 months, and even their sales double digit every single year. Maybe you can argue the growth is starting to slow, nonetheless 35% on a trailing 12 month is still very impressive, and we can see this from a numerical standpoint. Again, we can mention it here, they have marginally diluted your position over the long term, but right now it isn't a worry. They have been massively outperforming the S&P. ROIC also looking very good, above 10% for the majority of the last 10 years, 20% to note on a trailing 12 month. But one thing we would like to see is a little bit better in terms of their margins, although the efficiency has started to show through over the last few, but 11% on a trailing 12 month is starting to show a bit of a slowdown, perhaps something to bear in mind when we look at the margin of safety. Free cash flow margin, whilst inconsistent, does look good over the longer term, currently sitting at 34%, and pretty much the same as what we saw earlier on. This company won't even take them one day to pay off all of their debt net of cash on hand, same to be said over the next 12 months, so a very strong balance sheet. Then finally, institutional ownership fairly high at 88%. We do see 42 billion worth of sales over the last year. Only thing we would say, majority of this, in fact 90%, has come from Q4 2023. So if we were to strip that out, we would in fact get a lot more buying in 2024, which currently sits at 9.4 billion. But if we just look at it on a quarter by quarter basis, Q1 and Q2 of 2024, we get more institutional buying. Q3, not dissimilar in both buys and sells, and in Q4 we do have to point out there has been more selling than buying. Again, things just to bear in mind, whether or not it impacts the overall assessment, that is for you to decide. Then we get to the valuation, where our intrinsic value comes to $2,216. You can see here how we have got to this value. In fact, the growth rates we have used are fairly low, so that can be seen as a positive, but based on the 6% upside of 26, again, you can see here the different growth rates will come to a different conclusion, but based on 6% growth right now for Meli, you are getting quite a substantial MOS. In fact, around 20% up to $1,773 at 25%, not quite there yet. So you could in fact argue 20 to 25% with Wall Street fairly bullish, 32% upside noted with their price target of $2,320. Now, a few things to consider with this company. In terms of positives, they are dominant in the e-commerce platform in Latin America, strong foothold in key markets like Brazil and Argentina. In terms of their revenue streams, well, in addition to e-commerce, as we said, they generate revenue from digital payments, logistics, credit card services, which does reduce their reliance on the single segment. Latin America's e-commerce market is still expanding, and as a digital penetration increases, they do stand to benefit from growing user bases, similar things that we did mention for Grab, and the company also has a well-established and trusted brand in Latin America, which helps to foster the customer loyalty as well as sustain growth. In terms of some negatives to consider, while they do operate in several Latin America countries with fluctuating economic conditions, high inflation, political instability, which will overall affect consumer spending and business operations, and they do face competition from global giants like Amazon as well as local players in the e-commerce and fintech space, potentially limiting their market share as well as their margins. And despite their revenue growth, they have faced challenges in achieving consistent profitability due to high operating costs and investments in ultimately expanding their services. Finally, don't forget their company is affected by currency fluctuations, particularly in countries like Argentina, where inflation and devaluation have impacted their operations and their financial results. But in summary, whilst they do offer growth potential in developing markets, it is exposed to economic and currency risk as well as competition. And as we do go along, do give us your thoughts about these three companies below. We then move on to the third company, which is Micron Technology, a leading American semiconductor company that specializes in the design, development, production of memory and storage solutions. Now, the company primarily focuses on DRAM, dynamic random access memory, and they produce these chips using computers, smartphones, servers, and other electronic devices for high-speed data storage and retrieval. They also have the NAND flash memory, and they manufacture these, which are used in solid-state drivers, SSDs, USB drivers, and memory cards for data storage. As well as storage solutions, they provide a range of these for various industries, including enterprise storage, automotive, and consumer electronics, as well as involved in developing advanced memory technologies such as 3D NAND DRAM for high-performance computing, AI, and other emerging technologies. Don't forget they also serve a wide range of markets, including consumer electronics, data centers, automotive, and industrial applications. Now, last time we spoke very positively of this company. It was trading around $90. Right now, it's 10% higher, and over the last year, it is up around 21%. Over the last 10 years, they have also massively outperformed the S&P 500. In terms of where they sit, well, still to the lower end of the 52-week range. Double buy from Seeking Alpha and Wall Street. Now 4.46, actually not far off Wall Street's 4.5 to give this the strong buy rating. And it's the first one today that does pay a dividend, although on the lower scale at 0.46%. In terms of their earnings, love to see this. Not seen it today so far, but green right across the board. Last 4 quarters, 100% track record in terms of beating. And over the next 4 quarters, strong growth anticipated. In fact, the next 2 triple digit. And if you do look ahead to August 2026, the forward P will come down even lower to 8.7. We then move on to valuation, where they get a B+, but if you look at the P on a non-GAAP basis, this is telling us 14.3 versus 24.8. You are getting a 42% discount to the overall sector. Bear in mind, sometimes, in fact, the market does overreact, and this looks like one where it is a great opportunity to add to the portfolio. But again, if you do want to look, these are different numbers in terms of which valuation metric you do want to use. Growth grade, well, they get an A+, so a bit questionable why they are trading at a discount. Year on year, 80% versus sector at 4.7. Forward looking, 42 versus 5.42. And one thing we'd love to see, earnings per share, 37% over the next 3 to 5 years, with the sector comparative at 15.3. So looking very positive, doesn't stop there. Profitability at an A+. Now, yes, gross margin on the lower end, 31 versus 51, but bottom line is very high, 13.4 versus sector at 3.8, and we also like the cash from operations, 10.4 billion against 98 from the sector comparative. So quick snapshot then, double buy rating with a hold from quant, B+ on valuation, A+ on growth with an A+ on profitability. Now we'll take a look at some more metrics as they do in fact pay a dividend. Now we get a dividend safety score of 60, borderline safe. We'll touch upon these two valuation metrics shortly, but we do have to point out they haven't increased that dividend since 2022, and maybe not one that is important given we are looking at more of a growth company rather than a dividend payer. Now, the borderline safe score was reaffirmed just a few days ago, which means there is a moderate risk of a dividend cut over a full economic cycle. Now, if we look at this valuation metric, this does compare it against the 5-year average of the PE, and we do zoom into over the last year. The blue tunnel telling us what the expected fair price should be. Right now, it sits around the midpoint of that. This does, in fact, indicate reasonable valuation, but remember, we're not looking at any of these in pure isolation. We will run it through as well the DCF model. Now, dividend yield theory tells us a company is undervalued when the current yield sits above the 5-year, but not one we will use. They've only recently started to pay a dividend, not one they've increased, and not one that is of management's priority in terms of the capital allocation. Forward P though, pretty much in line with the 5-year rolling, giving us that reasonable signal. And as we've already highlighted, they are trading significantly lower than the information technology sector, so this is in fact trading at a fairly large discount. In terms of the free cash flow, bearing in mind this semiconductor space is very cyclical, that does shine through the numbers, but based on the next 12 months, a massive jump is anticipated from the 11 cents in 2024. In terms of the sales growth, again, cyclical, that is why we see 5 of the last 10 years, in fact, being negative, but 2024 at 62%, trailing 12 month at 80% does tell us we are expecting the next year to be very strong, and we can see the cyclicality shining through on a numerical basis. In terms of shares outstanding, very minimal share buybacks over the longer term, so not really too much to mention there. And on the ROIC, while we do want to see around 12% for semiconductors, we do get that some years, but not as consistently as we would like to see, 7% noted on a trailing 12 month, and the same to be reflected on both the operating margin as well as the free cash flow. These are the minimums that we want to see for the industry, not something we can see. But again, if we did look at a lot of companies in this space, we would get some very similar cyclicality shining through the numbers. On a more positive note though, the net debt to EBITDA below 1.5 is what we want to see, 0.54 on a trailing 12 month, expected to go to 0.34 over the next 12, so similar to the previous two companies, the balance sheet does look to be very strong. Continuing the theme of looking at institutional ownership, 81% for Micron Technology, around 8 billion worth of sales over the last year, a little bit more buying, 9.5 billion during the same time frame, and we also point out in the most recent quarter we do see more buying than selling, so overall institutions do look fairly bullish. And when we do look at our valuation, we can show you here the different growth rates, currently using around 15%. Depending on which one, you will get the different upsides, and don't forget you can grab this copy by clicking on the pinned comment below. Now, margin of safety, as we said, we did look at this not long ago where it was $90, so the MOS was higher, but as we go along in today's episode, what you are essentially looking at is not a 30% level just yet, but sitting right now at least 25%, with Wall Street very, very bullish. Their price target $137, where they see upside of 38%. Now, thinking about this company, the positive are they are a leading player in the semiconductor space, in particular to memory and storage solutions, with a large share of the DRAM and NAND flash markets. The increasing demand for memory and storage in sectors like data centers, AI, automotive technology, and consumer electronics provides a lot of growth potential moving forwards, and they invest heavily in research and development, leading to advancements in memory technologies such as 3D NAND and DRAM, keeping it competitive, as well as a history of generating substantial revenue and profits driven by the growing need for memory solutions across many different industries. Now, some negatives, we've already mentioned the cyclicality of the industry, periods of oversupply, price fluctuations, which can negatively impact their bottom line. They also face competition from other major semiconductor companies like Samsung and Intel, which can pressure margins and market share. And also, as a global manufacturer, they're vulnerable to supply chain disruptions, geopolitical tensions, raw material shortages, all of which could affect their production and the delivery. And remember, the company's performance is closely tied to the overall health of the tech and electronic sector, which can be impacted by economic downturns or changing consumer demand. So in summary, Micron offers growth potentials due to the increasing demand for memory and storage, but the stock may be volatile due to the cyclical nature of the semiconductor space as well as competition. As always, give us your thoughts about these 3 growth stocks today. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below. Grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. And as always, have a great day and we'll see you all on the next one.